Making sense of sky-high stock prices. Robert Shiller from the Cape fame, cyclically adjusted price-to-earnings ratio fame, has this article that was written 12/1/2020 in Project Syndicate. So let's go into this and see what old Shiller talks about. Now, I read this, I talked about this on my live stream the other day. So if you're not on my live stream every Sunday I think I'm going to start, well, I have been doing them on Sunday. I think it might change that to Friday, though. It seems like Friday got a better turnout. So anyway, so my live stream, long story short, I do live streams every week, sometimes twice a week, as long as I haven't been banned. So anyway, many have been puzzled that the world stock market haven't collapsed in the face of COVID and the economic downturn it has wrought. But with the interest rates low and likely to stay there, equities will continue to look attractive, particularly when compared to bonds. Let's see. There's been much puzzlement, especially in the United States, which has recently been setting record high. But maybe it isn't such a puzzle. A measure we call the excess CAPE yield, ECY, puts the long-term outlook for the world stock market in better perspective. So the CAPE wasn't working. So now we're going to create another version of the CAPE called the ECY, the excess CAPE. Indisputably, asset narratives are substantially driven by psychology and narratives. As a Nobel laureate Daniel Kahneman wrote, familiarity breeds liking. Really? Familiarity breeds liking? And several familiar narratives have emerged in the world stock prices this year, following the initial pandemic shock. All right, hold on just a second. Here's the book by Kahneman, Daniel Kahneman, Thinking Fast and Slow, and he did win the Nobel Prize, I think, in economics, even though he's not an economist. He's a psychologist by trade or psychiatrist, one of those things. Him and a guy named Amos Tversky, who wasn't part of the Nobel Prize, but they did the research on that we fear losses more than we love gains, if that makes sense, by a factor of 2 to 1. Very interesting. Actually, the interesting is that they're both Israeli scholars, and I'm surprised that BDS movement hasn't banned them for life, because BDS, anything that comes from Israel, they hate, and yet somehow still BDS reigns supreme on college campuses, which is nuts to me. All right, let's keep going back. I thought familiarity bred contempt. Anyway, but these narratives are the only reason why all of us have not but are these narratives the only reason why all of us have not considered pulling our money out of stocks and putting it into safer alternatives such as bonds? The CAPE, cyclically adjusted PE ratio, price earnings ratio, which captures the ratio of the real inflation adjusted share price to the 10-year average of real inflation adjusting earnings per share, appears to forecast real long-term stock market returns well in 5 influential world regions. When the CAPE ratio is high, long-term returns tend to be low over the next 10 years. When the CAPE ratio is low, returns tend to be high. Since the COVID shock in February to March, the CAPE ratios have recovered most of their pre-pandemic levels. For example, the U.S. CAPE ratio November 2020 is 33, exceeding its level prior to the start of the pandemic. In fact, it's now back to the same level as it was in 2018 January. There were only 2 other periods when the CAPE ratio in the U.S. was above 30, in the late 1920s and the early 2000s. All right, only 2 other periods. Does that say something to you? Like, it proves that when the CAPE is high, we're all going to die. Because in the late 20s, the market fell off a cliff. Obviously, with a Great Depression. In the early 2000s, the market fell off a cliff. Did it, though? Not necessarily. Certain aspects of the market did. Not all of it. What was the CAPE in 2007? I just don't know, but it wasn't above 30. Anyway, China's CAPE ratio is also higher than it was prior to the pandemic. The stock markets in both regions are skewed towards the technology, communication, services sector, all of which have benefited from the major narratives of the pandemic, which partly explain why the higher CAPE ratios relative to other regions. As for Europe and Japan, their CAPE ratios are largely back to their pre-COVID-19 levels, while only the UK is still well below its pre-pandemic level. Notably, these regions have lower exposure to the technology, communications, and consumer discretionary sectors. Market Hi. Market observers have noted that the potential role of low interest rates in pushing up the CAPE ratios. In traditional financial theory, interest rates are a key component of valuation models. Hey, Pablo. When interest rates fall, the discount rate used in these models decreases and the price of equities should appreciate, assuming all other model inputs remain the same. This is why I hate portfolio analytics. Assuming, or any kind of economic theory, assuming that we're in a vacuum, if we pull this string, that will happen. Well, you're not in a vacuum, man. So interest rates cut by central banks may be used to justify higher equity and CAPE ratios. Higher equity prices and CAPE ratios. Another thing about economics, they have I still think they teach it, the Phillips curve. They just all this insane stuff that if you have low unemployment, inherently high interest rates are coming. Why? Because it will have huge inflation, and as such, the Fed will raise interest rates in order to nip inflation in the bud. It's insanity, and they're still teaching this stuff. It's crazy. Thus, the level of interest rates is an increasingly important element to consider when valuing equities. To capture these effects and compare investments in stocks versus bonds, we developed the ECY, which considers both equity valuations and interest rates. Well, why were you using interest rates before, Robert Shiller? Jeez, man. Our CAPE worked until it didn't, so now we're going to create something else. To calculate the ECY, we simply invert the CAPE ratio to get a yield and then subtract the 10-year interest rate. 10-year real interest rate. Again, real means is net of inflation. This measure is somewhat like the equity market premium and is a useful way to consider the interplay of long-term valuations and interest rates. A higher measure indicates that equities are more attractive. The ECY in the US, for example, is 4%, derived from a CAPE yield of 3. Where are they getting the 3 from? We simply invert the CAPE. Okay, so to capture these, which considers both the calculate, we simply invert the CAPE ratio to get a yield of, okay, so they get a CAPE ratio, gotcha. So they're doing 1 over 33, so they get 3, I gotcha. All right, so we get a CAPE ratio of 3 and then subtract the 10-year real interest rate of -1. Okay. We look back in our time for 5 world regions up to 40 years where the data would allow and found some striking results. The ECY is close to as high across all regions as all-time high for both the U.S., and my phone is ringing off the hook here today, and Japan, UK and Japan. The ECY for the UK is almost 10%, and around 6% for the Europe and Japan. Our data for China do not go back as far, though China's ECY is somewhat elevated at about 5%. This indicates that worldwide equities are highly attractive relative to bonds right now. The only other time the ECYs were this high using our global data was in the early 1980s. And if you remember, PE ratios are about 5. That's when Business Week in 1979 did their infamous front page cover that said the death of equities. That period was characterized by depressed equities with cheap valuations, high interest rates, and high inflation. CAPE ratios for the 5 regions were in their low teens back then compared with the levels in the 20s and 30s now. These conditions are almost opposite of what we see today, expensive equities and exceptionally low interest rates. We cannot know how the pandemic will end, and it may end well soon with the advent of effective vaccine, but a key takeaway of the ECY indicator is that it confirms the relative attractiveness of equities, particularly given a potential protracted period of low interest rates. It may justify the FOMO narrative, fear of missing out, and go some way towards explaining the strong investor preference for equity since March. Eventually, down the line, bond yields may just rise, and equity valuations may also have to reset alongside yields. But at this point, despite the risk and high CAPE ratios, stock market valuations may not be as absurd as some people think. They got comments on here? All right, let's see what these guys. Exactly, John McDermott. This is embarrassing. Forget everything I told you before. It was wrong, so sorry about that. Hope you didn't make any life decisions on theories I've relentlessly promoted in the media in the past few decades. Man, I could not. That's 100% right, dude. I'm just an economist playing with Excel. The freaking thing I like Shiller. I use his stuff. It's on freaking I use his stuff in my books all the time. But this is nuts. We're using the same data set. One data set says the markets are too high. The other set says there's a reason. The same data. The other set said no, they're reasonably priced. What? So I would feel much more comfortable with Shiller's conclusion that bond yields today reflect the actual market rate of interest. Surely the whole theoretical basis for equity and bond valuations rests on using a market rate of interest, not a financially repressed government set rate. Exactly. The method of comparing bonds to stocks is more sophisticated, but doesn't really boil down to TINA. Yes, there is an alternative. Exactly. In an interview dated 220, what is that? February 28, 2020, Shiller claimed that the market was 40% overvalued and a huge correction was imminent. Now the market is up 15% from that. I believe he predicted housing was overvalued, contributed to the 2008 crash. Yet real estate, man, he belongs in the camp of Dr. Doom Rubini. So high stock prices and a pandemic and no mention of the CARES Act was... All right, to Dr. Shiller's co-authors, 3 CFA charter holders suggest struggle with the media representation of the paper. High stock prices make sense, Robert Shiller says. The low-level interest rates indicate equities may not be overvalued at all. So we've gone through Dr. Shiller's data. We believe we have better understanding now how ECY works and predictive value. We'll try to explain it here clearly, but it'd be great if one of you confirm. All right, I just don't. That's, God, man, these people. Thank you, Professor Shiller. Are you going all in? Not sure what the narrative is anymore. FOMO or Fed put market price. Yes, the ECY indicator reminds you of the PEG, price earnings growth ratio, to justify valuations in 2000. Yeah, basically, exactly. Basically, you are finally acknowledging what people like Siegel, Buffett, and Bill Miller have been saying for some time now. I'm sure the Democrats and socialist academia appreciate you bringing out this information after the election. I sense embarrassment, 100%. I bought and read your narrative economics book as soon as it released, and I tried to get the revised edition. Amazon told me that if I did, I would lose the underlinings and notes I made. Then I decided against it. It was perceived by bullies as afraid to read your book. All right. I don't get what he's saying there. All right. And these are the people that we trust. I had a guy who I respect, but this guy's, he said we need to have economists and technocrats every few years, for basically a year, just tell us what to do. These are your freaking technocrats right here. I like Shiller. I got no animosity towards him. These guys don't know they don't know any more than freaking, again, Bill Buckley's saying, I'd rather be governed by the first 200 people in the Boston phone book than all the academy or the academics at Harvard. So we're changing it after anyway. All right, so there you go. There's your justification for sky high stock prices by the same guy using the same data, who people are saying it's too high, it's too high. I don't know if it's too high. You don't know if it's too high, but can we stop with this insistence that academics know what the hell they're doing? When are you going to learn? These guys don't know any more than you and I. A freaking stopwatch is still right twice a day. Shiller did talk about rational exuberance. Yes, he had published the book in March of 2000. It happened to coincide with the markets finally crashing. But he had started to write that well before that. And Greenspan's discussion on rational exuberance was in 1995. All right, so real estate prices took a gamble. I mean, it was either going to or was not. I mean, freaking Burton McKeel says he ran a walk down Wall Street. There's always someone who's lucky. Yeah, all right, we'll see you. Love to hear your comments.